Well, hello everybody. We're continuing on with chapter 3, consolidation subsequent to the date of acquisition. We are going to look at subsequent years after the date of acquisition, and we're looking at the equity method in this regard. In a previous presentation, we were introduced to two other methods that the parent company could use to keep track of their investment on their balance sheet, one being the initial value method, the other one the partial equity method. So this objective deals with the equity method, which is where we are most familiar with. Okay, so we mentioned the three methods that the parent company is able to, or the options they have available to use to keep track of their investment. They have the equity method, the initial value method, and the partial equity method. So this will be for their internal record keeping. So the equity method basically gives us a total income figure that is reflective of the subsidiary's activity. As we said before, the equity method sort of resembles, the retained earnings movement on the subsidiary's account. The initial value is actually just giving us a measurement of strictly cash flows. So basically, we're going to keep track of the acquisition, the consideration transferred to purchase the subsidiary, and also any dividends, dividend income. For the partial equity method, it's sort of like a modified equity method. In this respect, the partial equity method is the same as the equity method, except that we are not keeping track of amortization. So in a way, it's easier to apply than the equity method. So these are the advantages of the three methods that the parent company would have to consider when adopting a method. So we have T accounts for under each method. We have the equity method with our investment and sub account. What increases and decreases this account? We said in the past that this is an asset. So debits would increase this account and credits decrease the account. The equity and sub earnings is an income statement account. So basically the credit increases the account, the debits decreases it. And then for the initial value method, we have the investment in sub account with is just the consideration transferred, and we have a dividend income account on the income statement. We have the investment in sub account for partial equity method, but note that we don't have the amortization here. So it's exactly the same as the equity method, but no amortization. The same thing under the equity and sub earnings for the amortization is absent. So this is basically just a snapshot of the differences between the three methods. You have a summary of these differences in Exhibit 3.1. So please review this, especially for the exam. And we're going to be working with an example here, parent company. Parent company purchased Sun Company for $800,000. And we have on January 1st, 2017. This is the same example that we looked at in the previous presentation for year one. So here we're looking at a subsequent year. And we have the book value on the date of acquisition of Sun Company. We had a difference that was allocated to assets that were under and overvalued. We still had a remaining difference of $80,000, which we call that goodwill. So now we're told, moving ahead, that now is January 1st, 2020. And we're getting ready to prepare the financial statements for December 31st, 2020. We are giving some additional information. Sun's Company retained earnings account is now $600,000. on January 1st, 2017 was 380. And we've also given a breakdown of some companies' activities, net income for 3 years, dividends, and then their balance on the retained earnings account. So as we said, parent company is getting ready to prepare the consolidated financial statements for December 31st, 2020. We also have that Sun Company has a liability to parent, which means that parent will have a receivable from Sun Company. And the retained earnings balance was the beginning retained earnings for 2020 is 600,000. So we fast forward to 2020. So we have a parent reports equity and subsidiary earnings has a balance at the end of 2020 of 153,000. And we have that the investment in Sun Company has been adjusted upward for Sun's Company income, downward for Sun's Company dividends, and then downward again for the net amortization expense. So we have a breakdown of the investment in Sun Company account from inception on January 1st, 2017 through the end of 2020. So we can see the ups and downs. The net income of Sun Company has increased this account over the years. The dividends and amortization has decreased the account over the years, ending with a ending balance of 1,082,000. So here we have our consolidation worksheet as of December 31st, 2020. Again, we are using the equity method, and we have our equity and subsidiary earnings in parent's financial records of 153,000. This would be the 160,000 net income from Sun Company less the amortization of 7,000. And then we have the investment in Sun Company of 1,082,000, and we have already shown how this amount came to be in the previous slide. Okay. So we're ready to do our consolidation entries. So we'll start with the consolidation entries that we already know from the previous presentation, which is consolidation entry S. We have to eliminate the subsidiaries common stock. So basically, no, I'm sorry, not common stock, but equity. So basically, this section of the subsidiary needs to go away on a consolidated basis. So in order to do that, we're going to debit common stock, debit additional paid-in capital, and then we're going to debit beginning retained earnings. And we explained this previously, that we are eliminating beginning retained earnings as opposed to ending retained earnings as we did in chapter 2, because in this chapter we have owned the company from the beginning of the year. And then the addition of these three components is credited to investment in Sun Company. So that takes care of consolidation entry S. Consolidation entry A deals with the differences in under and overvalued assets and liabilities. Now, we didn't have any differences in liability values as of January 1st, 2017 on the date of acquisition. So we don't have to worry about liabilities, only assets. We had trademarks that were undervalued, patented technology that was undervalued, and equipment that was overvalued. Okay, so the net difference came out to 120,000. Now, the trademarks has an indefinite life, and so we don't need to worry about that. Patented technology and the equipment, they do have a useful life. So remember that this is going to come into play in later slides. So we're going back to our consolidation entry A. We have our trademarks. The amount remains, that difference of 20,000 remains the same because trademarks has an indefinite life. The same thing with goodwill. If you recall from previous slides, goodwill was calculated at 80,000 on the date of acquisition. So that remains the same again because it has indefinite life. Now, the ones that we need to be concerned about is the ones that have been depreciated or amortized. In this case, the patented technology and the equipment. So look at the amount. Okay, so I want to bring your attention to the amounts that we're actually debiting, which differs from the amounts that we were debiting on the first year of operations, or the first year that they had acquired this subsidiary, that we were consolidating these financial statements. So we start with the actual difference from the date of acquisition. If we're looking at patented technology, it will be the 130,000. So we begin with the 130,000, and then from 2017 to 2020 we have 3 years. So we have to take into consideration this accumulated amortization. Okay, this accumulated amortization is kind of kept off the books because, as we recall, the consolidation entries is only for the purpose of consolidating both financial statements. So none of them, not parent, not son company, will be journalizing any of these transactions. So in their books, we'll still continue to show the same amounts. So we're going to have to manually have these consolidation entries year after year until pretty much they dispose of this asset to a third party. So this accumulated amortization is used to reduce this difference of 130,000. So the net amount that we are including in our consolidation entry is 91,000 for patented technology. And we do the same exercise for equipment. But remember that equipment, so the patented technology was understated, so was trademarks, but equipment was overstated. And so in this case, we're crediting the equipment. And again, we take into consideration this accumulated depreciation from 2017 through 2020. And then we reduce this difference of 30,000 that we calculated on the date of acquisition by this accumulated depreciation. And so we have the $12,000 here. And then again, this plug difference goes to investment in son company. We continue on with the next consolidation entry, which is to eliminate the income. In this case, son company had income. And so in parent company had recorded a balance of, had an ending balance on their equity and investee account or subsidiary earnings of 153,000. So in order to eliminate this, we're going to debit the equity, and then we're going to credit the investment in son company. And then entry E is to record the amortization / depreciation, and also to adjust the equipment and patented technology amounts. So we have amortization of 13,000 for the patented technology, which was understated, and we have a credit to depreciation expense, debit to equipment because the equipment was overstated. So we have the complete consolidation worksheet as of December 31st, 2020. And so we can see that let's see if I have, oh no, I don't have. Okay, we have, we got rid of some company's equity section of the balance sheet. So under consolidated totals, the equity section mirrors again the parents. So we are okay on that. We can see that we have zero out our investment in son company, and we zero out our equity in subsidiary earnings. Okay. And if you can trace back the consolidation entries, then they should all agree. I think the new entry that we didn't have a separate consolidation entry will be entry P. And entry P was to get rid of the payable on Sun Company side and the receivable in Paris Company side. Okay, so this was an intercompany receivable payable. So we need to get rid of that because we cannot owe money to ourselves, right? So since we're becoming one under consolidation totals, this needs to be eliminated. So that concludes our presentation for this learning objective.